Hi, I'm John Gatewood, founder and CEO of Gatewood Wealth Solutions, where we are on a mission to help individuals and families become and remain financially self-reliant. Welcome back to our Market Insight broadcast. With me today is our Chief Investment Officer, Aaron Tuttle. Welcome back, Aaron.
John, I'm glad to be here.
Or should it be welcome back to me since I was out last week?
Yes.
Well, we've been hearing a lot about inflation in the news, and
yes.
clients have been asking about inflation. People are starting to really see it and thinking, is it truly transitory, which is one of the things we talked about last week. So let's get on to that topic.
The Google searches for inflation, and this is going back all the way to 2004. I don't know how many people were doing a lot of Google searches in 2004. It was still fairly new, but we can see that as even going to 2014, whenever it was certainly pervasive at that point, the amount of people searching for inflation is significantly higher. We are getting a lot of calls, and it's dominating the headlines, especially after last week the PPI and the CPI, so the consumer price index and the purchasing price index. One of it is the inflation measure for us as consumers. The other one is the inflation measure for producers of products. And both of them went stratospheric relative to where it's been. Now, this is an annualized component, so it's just taking the recent print and compounding that. Inflation doesn't always work that way. Not always. It seldom works that way. There's always ebbs and flows, gives and takes. Because as one product is moving up in value, let's say your food, that usually means that there's less money for most of the consumers to spend elsewhere, so other products are going to pull back.
So how does that look in terms of inflation, in terms of the variability?
Well, we've been talking about the one that inflation risks were high, but that it would be important to look under the hood, not just look at the broad index.
What's actually costing us more and what's costing us the same?
What's driving the index up? And over here on the far left, we look at things that are reopening prices. So we can see transportation services. Think airfare. So as the economy's reopening, I think it was Delta or United, one of the two, just opened 400 different flight paths that are now an option again. People are buying airline tickets. That's going to create demand for those tickets, and they're going to go up in value. Also, air travel is very energy dependent. So we're going to see increases in the need for fuel.
Have gone up.
Right. So you'll have some demand pulling that price up. And then we can also look at other things like temporary supply. So we have supply and demand. It's all just sad, right? So temporary supply disruptions. So it's not just the demand component. And if we look at what really drove the CPI up on this most recent print was used car prices. Well, what's going on there?
What is going on there?
We have semiconductors. As we moved into the lockdown phase, and we had this work from home, really, which would have happened over the next 4 or 5 years, become more and more available for workers, all of that was brought forward. That's going to require a lot more computers, a lot more screens, and a lot more entertainment. So what wasn't expected was a lot of technology being sold to deal with the work from home aspect. So there was a lot of those chips that had to go in the TVs and monitors, et cetera. At the same time, the semiconductor manufacturers anticipated lower demand. And they, especially in the automobile industry, so they didn't make near as many chips. So now we have the supply chain where there's semiconductors, and if we look at the amount of conductors in cars, it used to only be the ignition. Then we got fuel injection. Then we had all the LCD displays, and the amount of cost, I think it's around 50% now of a cost of manufacturing a car is in the computer chips. And there's a major shortage of that. Well, that means new cars are not coming off the lot as fast. So that means demand for used cars has gone up dramatically, and that's pushed the CPI.
So do we expect that the supply chain will eventually fix itself, where we get kind of a normal manufacturing pace of new cars?
Right. So if we look at what are the areas that the supply constraints are really showing up, we do think that part is transitory. If we look at LA ports, because a lot of the traffic coming from Asia is going into Los Angeles ports, there's a backlog. And that's making it really difficult to get products here through that. I think the backlog, I think there's about 19 ships sitting off at anchor. The average has gone down from 6.8 to 6.6 days waiting. There's another additional ships that are going in, but they expect that to be cleared by June 1st.
So would that mean that, let's say, for example, a used car, would one wait to buy a used car until the...
Well, it all depends on what you need. I mean, if you need a
Right.
car today, waiting many, many months for prices to go down may not be something, you're going to have to pay the premium. There's just a demand. If you have the ability to sell a used car and you're wondering what's a good time because you're not using it, this is probably a good time to do that. The semiconductor, so the demand or the supply of goods coming in, the amount of imports is something that's causing price increases. But then the chips are also causing issues. That's probably not going to be settled until 2022, where the ports are probably going to be cleared by the beginning of the month. Then we also have lumber. The sawmills were closed during COVID because they didn't expect housing starts and all the others. They expected a slowdown. That is not what's happened. I think Zillow is calling it the great reshuffling. As people move from California, New York, and they go from what are typically blue states to the red states, the sun states that have low taxes and have had less regulation. The houses that they're leaving in California or New York are not all being bought by somebody else. It's not just an exchange of homes. And they're needing a lot of new homes in Florida. I've seen lists where people are just on the list and they're 30, 40 in, and there's only going to be a few lots.
Right.
Well, that means that they didn't get it right, that not only would the supply of lumber need to be steady, it actually would increase because there's a need for a lot more homes to be constructed because ones that are leaving are not necessarily going to be occupied.
If you're to forecast, how long do you think that type of backlog will be, let's say, for home building?
So the sawmills are in no hurry to expand their production. Their profit margins are very thick. You can see that their earnings after all their expenses have gone up dramatically to this. So they're not in a hurry or a rush to solve this problem. And there's another area that I thought is just unique and characteristic of the corona is the amount of dining out. Mm-hmm. Is actually caused a ketchup package shortage. So
my ketchup, you mean I may not get a ketchup package when I go get my hot dog
you'll
today?
probably get it.
They may limit it to one.
Yes. And if you actually have a lot of ketchup packages sitting out there, it's probably going to go away as we reopen and the dining in option comes back. But you can sell your ketchup packets on eBay. I've seen 3 for $1.50, 50 cents a ketchup packet. I don't know who's buying it, but
probably costs more to mail it than it does.
Probably nobody, but you can see that there's a demand for things. So it's both a supply and demand problem, but the supply issues are probably going to be transitory. Then there's the infrastructure problem that we have, because it's not just the supply and demand. We've had investments in renewable energies. Texas was an example where they had 20 to 30% of their energy supported by renewables, and they also have, in conjunction, built a lot of gas power plants. What happened is they've layered on risks. This is all still new, and it has to do with the way that utility companies deal with wholesale prices and the cost. So if you're a renewable energy, there's no cost. So that's the first area to get filled in the demand component for utilities. So there's been an emphasis to continue to add those because for the most of the time, they're low cost. But they're not consistent. You can't rely on them. They're dependent upon the weather system, and a lot of times your energy use is going to be very much related to that weather system. So if there's inclement weather, a lot of times you need additional energy. So they built a lot of gas plants to offset and be able to ratchet capacity. Mm-hmm. But as Texas lost 30% of their ability to produce energy from the renewables, it shifted to the gas power plants, but they didn't winterize appropriately, so they compounded the risk factor of cold. And a lot of this is new, so that new infrastructure isn't time tested, and a lot of the solutions and obvious things that we'll find out over the next several years as this becomes more pervasive aren't known. So new infrastructure is not necessarily as dependable. And then you just have happenstance. The Evergreen, whenever it was caught in the Suez Canal, probably has nothing to do with coronavirus or any type of policy. It's just by chance this is going to happen.
It was an accident or driver error. Who knows what it was?
But this is a part of the infrastructure that helped add, as part of that perfect storm where you already have supply chain constraints and now you have this stuck. Maybe they were going too fast because of the supply chain constraints, and maybe it is related. But for the most part, let's just say it's human error. And then you have not new infrastructure, but antiquated infrastructure that hasn't been updated.
Wherever that bridge is, where that big crack is, I hope we're not driving on that later today.
Well, so stay out of West Memphis. So this is a bridge connecting West Memphis with Missouri, and not only did it stop the traffic crossing, which caused a headache in that city, a logistical nightmare whenever you're trying to cross, but the barges couldn't cross underneath it. And those barges carried an enormous amount of agricultural products, corn, wheat, etc., that wasn't able to go in, so there was a blockage there.
Right, so there's critical infrastructure repair that needs and rebuilding that needs to be done.
And that goes back to that infrastructure bill, but whenever we look at what the infrastructure bill is dealing with, a lot of times it's not dealing with a lot of this, it's more helping individuals or people. So there's been a lot of criticism on what is considered infrastructure on that bill. The politics, the Republicans are supposed to issue their counter proposal, so we'll see what that comes out of, but it's clear that we do need infrastructure spending.
Yes.
The other thing is the ransomware attack, cryptocurrencies, was how they were paid, and now the people that did this and got paid the cryptocurrencies, a lot of it has been stolen from them. So there's all kinds of things going on, but that stopped the pipeline that pretty much feeds the entire East Coast to southern Sun states, and there was gasoline shortages. And then when you have price gouging laws that say you can't raise the price. Totally understand why that's there, but you had people, and there was a lot of memes that were going on the internet where they were filling Tupperware containers. They even had to put out a warning that said, don't fill plastic bags, and don't fill plastic bags with gasoline. The gasoline's going to eat the plastic.
Eat through the plastic, and then you'll have gas all over the ground.
And if you would have raised the price of gas to let's say $10, $15 a gallon, you probably have less of that happening. Obviously, the pain at the pump for an unexpected crisis, though, is still that's still there. But hopefully, that would have stopped and made people economize and only purchase the amount of gas. But imagine if that would go for quite some time. How do farms get their fuel to run their tractors? How do the tractor trailers run efficiently to try to offset the pipe? So there's clearly some problems there, and I'm sure our foreign enemies are noticing, hey, if you do a couple of critical areas within I think it's 1,900,000 miles of pipelines out here in the U.S., that could actually bring the U.S. economy to a standstill. So obviously a problem there as well.
So how do we view all of this in terms of the economic recovery and where we're going?
So we have the supply issues, we have infrastructure issues, and then we have the commodities market, which is pulling back over the last few days, which is good to see that coming back. Once again, we're not going to see probably additional sawmills, so some of this is probably going to continue on in the commodities market where we see rising prices in commodities. And then you talk about political risk. So one area that's been a big boom during this home construction has been copper, and copper is also used in infrastructure. To add just complications, Chile just had an election. And the far left in that country has now gained control of the government, and they're wanting to nationalize a lot of the commodities procurement industry, which is the main industry of Chile.
So what would that do to, let's say, copper?
So they are 67% of the copper production globally that is now going to add to the problems that we already have. In addition, lithium, they're a major producer of lithium, which is crucial for electric vehicles. One of the bottlenecks for a lot of electrical vehicles becoming the norm is the amount of lithium that we can extract. We probably can't extract it based on current technology to meet it. Now, there are people that are working on making synthetic lithium just as they make synthetic diamonds. But that if we can't go to the alternative energies, if we can't store other energy, that's going to put additional upward pressure on oil, as that will still remain a major part of the transportation factor. So there's a lot of things that are going on that suggest that there are probably multiple waves to inflation, and obviously inflation is always transitory. It's going to end at some point, but I don't think that's what the Fed means. So there's additional waves. Another wave is whenever we start to look at wages, especially lower wages below 60,000 or less, there is sharp increases. Now, Chris and I talked about the unemployment benefits. We don't think that was the cause of the Bureau of Labor Statistics miss the previous, I guess it was the previous Friday. But there still is going to be a group of people that are getting paid more to be on unemployment that will not take the jobs, or at least they will find not working and maybe getting paid a little bit less as a better alternative than getting jobs. So it's causing...
And that'll ultimately just phase itself out in September.
In September, and Mississippi. So we'll see how much of an effect that is, because there are about 10 states that are going to end it early, to see how much of an effect that has. There's a lot more to just the unemployment benefits.
Well, we already see a number of the big companies just raising their minimum wage.
Right. That's probably why we're seeing wage increases on the lower wage income, which may not be a bad thing.
That's going to be important for them to be able to keep up with this inflation.
As much as you have people on the right that are criticizing the unemployment benefits as causing this shortage, you have others saying, well, hey, great, now they actually have to raise the wage to a competitive and living wage. So there's different angles that you can approach this, right? But we can see that it's certainly having an effect because it's the lower income areas that they're having to compete against these benefits, and where we're seeing those sharp rises. Now, and this is not them being irrational, the lower income, the more money they get, the more money they're going to use for consumption. They're still trying to meet their consumption needs. So they're probably going to upgrade their food or buy more food. They're going to upgrade their shelter, add clothing, because they've really been skimping there. And as their wealth increases, that's probably where the next dollar is going to be spent. It's not going to be spent in savings and stocks and other financial assets. So we'll probably see consumer prices from higher wages on the lower income help be an additional wave to deal with on the inflation. And then if we look at the recent stimulus, so all this inflation is just supply and demand and the way benefits are affecting wages. We haven't even talked about the amount of money that was created by the Federal Reserve to fund the government stimulus packages. And if we look at the government spending and look at the personal savings rate, we can see that a lot of that money is still sitting idle, ready to be put into the market. I know the market's kind of selling off over the last few days, but there's likely to see a nice uptick in retail sales because a lot of this money is going to make it into the economy as we get into reopening. So we think that the Federal Reserve in their statement on transitory, very, very short term, is probably going to be incorrect. And we're seeing that in the market where inflation expectations on bonds are projecting out 2.5–3% inflation for the foreseeable future.
So ultimately, wouldn't you think that would lead to higher interest rates?
It should lead to higher interest rates, but if the Fed is acting as the market and buying up bonds, if they start to do their yield curve management or yield curve control, and they're stepping in and they become the market, you could see interest rates stay stable while inflation's high. We already see that inflation's higher than what you're getting paid on bonds, so we can already see that that inflation premium in bonds, it's not showing up. And it's probably because the Fed is really the one that's acting at the margin and becoming the market for that.
So what should investors do in that type of an environment?
We continue to favor equities. With the inflation showing up, we've been growth, especially in taxable accounts, and you want to be value. And qualified accounts, we've certainly made that rotation towards the value. We've added commodities, at least in the short term, as well as real estate that's been holding up. So we're doing a lot in the qualified accounts to offset this effect. Ultimately, we think technology is going to win out again. and we have a lot of gains from last year's big run in the growth portfolios. So we're trying to make those changes without having an enormous amount of tax liability show up on a year that's so far been flat in our taxable accounts. So we're trying to manage that tax issue and the changes that are probably going to be maybe not transitory where it's just one jump, but it's probably going to take a few quarters. And then we'll get back to a growth-oriented economy again. Those are the changes that we're making. We can see that the S&P 500 bounced off its 50-day moving average. So those that think technicals are just reading tea leaves, we agree it is reading tea leaves, but a lot of people pay attention to it. Right. So it bounced right off the 50-day. I think there's a good chance that we go through the 50-day moving average and we try to get some consolidation here in the market. If it starts to get a little bit more, there's more concern. Know that infrastructure bill is going to be passed sooner rather than later, and some of the stimulus, because there hasn't been a lot of pain felt. Even though we're starting to see the inflation, I think that would be the reaction, because the Fed is more concerned about the unemployment rate, and they are willing to let it run hot because they believe it'll just be transitory as supply chains.
I was reading yesterday about how the Fed was talking about that we're still 8 million fewer jobs than were pre-pandemic, and so they want to close that gap before they start to do anything.
And those that are talking about the unemployment benefit issues would point out that the reason that that's so high is because we're paying people, we're incentivizing people to not take the job. I think there's some truth to that statement. I don't think it's the entire part of the story, though.
Oh, I'm sure.
There are a lot of companies and small businesses that are just not coming back. So it would be unusual to have all the job creation and the job availability that we had prior. There's got to be some recovery here as well.
So one of the things that we hear from clients is, are we in a bubble? Because of the fact that we still are high, and while we've talked about how the money supply is pushing asset prices up, there is that concern, I guess, that I think, are we hitting a top? Are we hitting an inflection point?
A lot of people talk about the everything bubble. I think that is correct. That financial assets valuation is very high. But what are you going to do? You're going to go to the dollar whenever the reason those financial assets are very high is because we're increasing the money supply dramatically. Well, you're going to lose the purchasing power. If we look back in history, especially since, let's say, 1926 and onward, really 1913, equities are going to do better over the long term because you're buying the actual production of the economy. So that's the place that you want to ride out. Yes, they have more volatility, but if you were to take this is information from, let's say, 1993's Jeremy Siegel's book, Stocks for the Long Term. He looked at what if you would have bought a bond in 1926 for $1,000 after inflation and after you paid taxes. By 1993, your $1,000 is worth $345, where stocks are substantially higher. So you have to deal with the volatility in stocks to get those higher long-term, especially whenever the central banks are accommodative and trying to keep financial asset prices up. That's your best long-term strategy. Now, that doesn't mean that bonds don't play a part, because you may not have 10 or 20 years to make sure that that is a true statement. And you may need some money in the near term, but that's the importance of having a little bit of a buffer on bonds as well as cash to withstand that.
Even though we believe that asset prices are going to go up over the long term, we're going to have periods where they decline.
Yes.
So it's not that they're declining, but that you don't want to be in a position where you have to sell that asset during that decline period. That's why we have our cash. And we'll have some bonds to manage some of that volatility.
And especially if you're in an inflationary environment, which we believe we're moving into, that you want to be in real assets or things that are producing real assets, not fixed income, not cash. They have their place, but that's not what's going to help clients become and remain financially self-reliant. And then if we look quickly through the technicals, large cap value, that rotation is coming back on. The S&P 500 is still doing better than most of the international asset classes. We can see commodities is near the top. Real estate is doing well. Gold has been moving up. So there's been this statement that Bitcoin was taking all the flow from gold. Well, now that Bitcoin's moving up, moving down, gold has been moving up. I don't know that it's necessarily taking the flow from Bitcoin, right? But those two assets have been negatively correlated as of late.
Well, that's all the time that we have today. So thanks again for this recap of the market this week. There's a lot going on with inflation and how we're going to be dealing with that. We'll be reporting more. Certainly, I know that our listeners are concerned about the all asset price bubble, but we are aware of what's going on, and that's why we want to make sure that all of our clients are positioned with enough cash to weather any storm that we're going to have.
But also making sure that we offset the bigger risk, which is losing your purchasing power over time.
Right. It's not the preservation of principal, it's the preservation of purchasing power.
Yes.
Because just like you don't want to go $1,000 being worth $340, whatever it was.
345.
345. You're a better man than me on that number. So thanks again for joining us. As always, our goal is to give you our perspective based upon analysis, data, and economic theory to apply them to the current events of the market and the economy so you can be better informed and have actionable things that you can take away. So thanks again, Aaron. If somebody wants to share our information with their friends, what should they do?
Well, if they're in the YouTube viewer, they just click down on that arrow and send it out. They can text it to their friends or they can email it to their friends. Also, while you're down there, if you enjoyed this conversation, please hit that like button. And if you're not already subscribed, hit that subscribe button as well so that you never miss an update, whether it's a weekly market insight where we take a deep dive to give actionable advice so they can make informed decisions, or even to get the skinny on the 3x3.
The 3x3. So you can find out what's going on every day.
Except Friday.
Except Friday. So thanks again. We truly, truly appreciate you tuning in and listening to us, and we hope to see you back next week.